Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Wednesday, January 8th, 2020. All right, let's start out with what happened yesterday. I've covered, quite a bit of updates for subscribers, but we're going to do a general market wrap here for the public, including the YouTube channel. And I wanted to start out with what happened last night. Okay, as most of you probably know by now, there was an Iranian missile attack on a couple of U.S. military bases, and that had taken the futures down in the after-hour session shortly after the market closed. So I did an update last night. I usually don't come on this late, but right around dinner time. I mentioned that it was in, of course, again in the after-hour session, that shaded gray there, that Apple had broken down below that price channel. But of course, I said most importantly, you have to see it stick. That was an an after-hours breakdown, and what you want to see is a breakdown like that stick. So had it stuck into the regular session, that would have most likely resulted in additional selling in the broad markets tomorrow and later this week. But it didn't. We'll get to Apple in just a second. And then at the same time, the title of that post was Apple Breaks Support Index Futures Coming Up on Support. So we had currently both NQ and QQQ falling to support those key levels, same levels I've been harping on for a while now. You can see it here. That was QQQ. I'll zoom in a little bit there. That 2142, I've been talking for a while. We were right at that level, and we had NQ. Zoom back out here, go to that previous chart on NQ, and the same comparable level for NQ, which was 8694. And so we were there at the time, and let's close these out and get back to that post. And what I had said is, look, we're at support. Support is support. I said, a solid break below that without a snapback recovery following a brief undercut of those levels would likely bring in more selling. What does that mean? I talked about it today. That's what I call a momentum field overshoot. When you have a near vertical drop, a vertical plunge on a stock or an index like that. This is a typical example. It's probably no better example than that. That is complete downward momentum. That's a vertical plunge. What happens is you tend to overshoot the support level, or if you have a near vertical rally, let's say 88.11 was a level I thought would get a reaction, it's almost better. It is better than 50% odds that you're going to have at least a brief overshoot. And again, I use the analogy like a pitcher throwing a fastball, hits the catcher's glove. The catcher's glove is going to snap back a little and then return back to the point the ball hit it, like that. So that's what happened there. And so support held. So I'll get to the updated charts in a second. Again, these were last night's charts, so we were right at support. And I even went on to say, which I did, myself, if you're an active trader, you could reverse there because you're at support. The futures were down big. Cover an NQ short and reverse to a long position. It was really too late to do with the index ETFs because although they were still trading at that point in time, they shut down, and then you can't get out. You're trapped, and that's why futures are nice because they trade around the clock and you have liquidity in ES and NQ. So that would you could reverse there and try to game a bounce. Now, I'll say this, I didn't think the bounce was going to go that far, but let's look at what it did. It certainly went farther than I thought. I wish I would have stayed long that whole way. I didn't. But either way, it was a big turnaround, and you have to give that to the bulls. That is a better than a 3% recovery off the lows. But again, a lot can happen in the overnight after-hour session because you don't have all the players on the field. So the futures can be a little wonky, and that's why, like with Apple, for example, here we'll jump to that real quick. With Apple, we never closed below there. You can see that we opened up right back up on the within the price channel. I zoom in real tight. Here's that price channel. So we had a breakdown in the after-hour session. Then the futures reversed. Apple shut down for trading, but then opened up this morning, and even before the open was back above within the price channel. And so what it did today, it went on. If you recall, it had this midpoint line here. I often put a midpoint line in a price channel. This is the upper channel line up here, lower channel line in the midpoint. Now, I've said this before. I don't put that midpoint exactly. Sometimes I'll have it a little higher, a little lower. It's just where the reactions, you get most of the reactions. You go along there and you can see it does a good job of acting as support and resistance. So Apple hit that level today and won to every single candle since. Look at that, testing that level just like it did back here and here and here. So this is pretty simple. bullish if Apple pops midpoint of the channel, because then it most likely opens the door for a run to the top. That's the typical MO. That's the trading strategy, the modus operandi. If you're going to trade a price channel, what you do is you go long at the bottom of the channel, and you can either cover your long at the midpoint channel, or you can hold out for a move to the top of the channel. As I showed you before, each of these tags on the bottom of the channel have resulted, except this one so far, that's something to note, but all of these other ones resulted in a move back up to the top of the channel there. And so far we're struggling with the bottom of the channel. Now that's not unusual. Usually you hit the midpoint and you get checked, until you can break above it. Most of the time you gapped above the channel, actually in every instance there. So we'll see what happens. That kind of gives you some visibility to what Apple's going to do. And I look at Apple because it's the largest component of the NASDAQ 100, I think top component of the S&P 500 as well. And so, breakdown on Apple of this channel, which I still think is likely. We don't have it yet. So to be clear, we came very close last night. But that was last night, and we certainly didn't come close today at the open, when after the futures had already reversed, and we had basically successfully defended those support levels on both QQQ and NQ last night. So here we are. The divergences that were in place are still intact here, as Apple's eked out a marginal new high. And when I say marginal, it means just slight new high. The previous high was at that level, and so today's new high was about 1.6% above where it was before. So that's it. Still in there, no sell signals yet. QQQ, again, I'm not showing the after hour trades here. I had this trend line here because that's actually where we tested last night. That had a little minor trend line there that was popped. So again, you're not seeing it here because this is not showing the after hour trades, but that's the level we hit last night. And reverse there to 1142 with just a slight momentum fueled overshoot. And as I showed you on that chart there, we closed back above it. Where is it here? Right here. Oh, it's not on there. The candle, even last night, those 60-minute candles, I took a screenshot earlier today. Both NQ and QQQ, the 60-minute candles closed back above the 211.42 and the comparable level again, which is NQ 86.94. So that's it. Came close, but no cigar on the sell signals yet. But at the end of the day, we look at the technicals. Nothing technically has changed. Again, I'm going to give it points. This was impressive recovery for them to step in and buy the futures up that hard. Once again, the buyers step in or taking advantage of the dips, and so these levels remain. I'll leave it color coded as yellow, the most important level to go. And once we get that, chances are it opens the door for a deeper correction. As far as did anything change today, with that impressive reversal? No. We closed up an impressive 3/4 of a point. Nothing big, but again, we started diverging right here at this point. There's our divergent high. We had a little correction. Divergent high, we had another little correction, and once again divergent high, and it's all just really an extension of the same divergence right there. So that's it. We'll have to wait and see what happens tomorrow. A couple other things I want to show you when we go back to the futures. And guys, I'm just going to stick with NQ here, keep this one relatively brief, because to me, again, it's all that matters. Until these market-leading tech stocks break down, market's not going anywhere. It's all about technology and the FANGs: Facebook, Amazon, Microsoft, Apple, and that group of five. So what am I looking at here? So remember, we had recently a breakdown below this 60-minute trend line on the NASDAQ 100 futures. Again, we're on NQ here. Breakdown, and we made a back test. Now we also have a second pattern developing here, and that is a broadening wedge pattern. So you have the uptrend line right here, and a trend line right here, and this is what prices are bouncing between. And so far, this takes the form of a broadening wedge pattern, aka megaphone pattern, because it looks like a megaphone. So we're at the top of the pattern. Usually, you'll only get 3 tags, and that's what you need at least to satisfy the the pattern. 3 tags from above, at least 2 or 3 from below, and that's what we have so far. So if we go up much more, it sort of foils that pattern. Let's see what happens tomorrow. If we come on down here, then again, you can see some levels to watch. I'm going to add one right here, right now. Just a near-term level right there. And finally, I want to show you. So let's talk about Megaphone Patterns. And I have an example here. Here's one from, let me pull that up for you real quick. Okay, we're going to look at crude, usually for the end of day market wrap. If it's a public video, whether it's available on the site or on the YouTube channel, that's usually only limited to general broad market analysis, general stock markets, stock indexes. We're going to talk about crude because we had a very almost identical looking chart. I posted this one back on April 8th of 2019, and it was a 60-minute chart, just like we were looking at on NQ. And you had the same thing. You had a uptrend line. Very similar uptrend line right there. You had divergent high before it broke down, negative divergence, and then you broke down. And then what happened is, instead of breaking down and zigzagging down, what we did is we started forming this ascending broadening wedge pattern, which was pointed out at the, or I'm sorry, broadening wedge. An ascending broadening wedge looks like that with an upward slope, whereas a regular broadening wedge is like a microphone like that, more level. All right, so that's a broadening wedge pattern back then, and let's see what happened to it afterwards. Remember, that was, oops, there we go, that was April 8th. That pattern continued to form for just a couple more weeks, and let me find a crude chart down here, the updated chart. And here it is. Now we were looking at a 60-minute chart. I can't go back all the way to April on a 60-minute time frame, so I'm showing it to you here on a daily chart. This is CL crude futures, but we're using daily candlesticks. Here's the months right here. So there's April 8th right here, and so that's when that pattern was forming. It went on to continue to form. There was the uptrend line. Remember, we had that 60-minute uptrend line, just like on QQQ or NQ now. And here's that 60-minute broadening wedge pattern. And it looked like, and that was a major top in crude oil back then. And you can imagine crude bulls were every bit foaming at the mouth as stock bulls are most likely today. We'll see what happens, guys. There's no sell signal yet. But what happened here, and this is a nice example of an ascending broadening wedge, there's something, and I would encourage you to Google this term. It's called a partial rise. A partial rise occurs, it's one way. Now, you can get a sell signal on a downside break of the wedge, but sometimes you get one final kickback, and it comes up usually somewhere anywhere about the midpoint of the wedge right there. And that's what happened. So you had a sharp drop in crude off the top of the wedge. Then you had a kickback to the midpoint, and the strategy, and I've used this in the past and highlighted, you can short there. When you get a kick, if you happen to get a partial rise, you can short with a stop. I like to put about 2/3 up into wedge because we really have no business at that point getting there. And you can see that was, again, a major top in crude. That was it. You got the partial rise, and then the bottom fell out of crude oil. And I wanted to make mention on that. Again, usually it's keep to the broad markets here, but let's talk about the crude for a second here today. Here's USO. Let's get rid of all these lines and just take a look at candles here. Today, crude had a smackdown. It rallied. It popped hard last night on the missile attack news, but they faded that like nobody's business. They faded all of last night's gains and then some today. And as you can see here, we're on a daily chart of USO. USO is does a good job. It's one of the ETNs that track crude. It's non-leverage, and you can see this candle, today's candle. We haven't seen a candle like that since right here, and that was a major top right there. We had a big bullish candle. Crude was rocking right there, had a big up, and then a boom, a big red candle comparable to this one, and you can see the big drop after that. So something to note right there. And what I like to do too is we can take a look here at USO. Let's get rid of all. Let me find a clean board here for you. One second. Okay, if you look up top, what I've done is the USO is in white. We'll just use a simple line chart to show you the example. And then the market, or at least QQQ, that's the index I really follow closely, and it's a little more volatile, so it'll show you this, is in purple. And you can see what stands out to me is this huge disparity. And again, oil plummeted today. Big sharp down. This is, by the way, a 15-minute chart I'm using here. So you're going to see, the daybreak lines are right here, just to kind of give you an idea where we are. There's today's big swoon down, and yet the market continues up. Now, what stands out to me is, let's just get rid of today's little move there, and now we're going to roll back in time. Look at the correlation between these two. Don't pay attention to exactly if they're moving up. Just look at the trend. Are they moving up and down at the same time? Not the difference between each one. And you can see, as I've talked about for many months now, crude oil and the stock market have traded very, very closely. A high correlation, based on economic growth expectations. And I just want to point this out. So we're rolling back in time, and we haven't seen a divergence like this, like today's divergence, in quite a while. So just something to note there in case there's more downside in crude oil. That's kind of just a quirk. We'll call it a yellow flag, not a red flag right now. Ideally, at times the market lauds, rallies on falling crude prices because it's deflationary. Oil, if crude gets too high, it is inflationary. It hits people in the pockets, hit businesses in the pocket. But again, I wanted to point that out because there's a lot of program trades, hedge funds, things like that. They're all tied in together. And if these crude longs, obviously there's more longs when you're in a strong uptrend like this than shorts. So if the crude longs start to feel pain, if there's more downside to come in crude, if this wasn't a one-day wonder, then that could have some implications on the market. But either way, I just wanted to point out, if you didn't catch it, the huge disparity between crude and the stock market today. Okay, let's just cover two other charts and we'll wrap this up. All right, so I've covered this recently. I boxed in right here. The red box shows you a trading range which measures about 1.5% from top to bottom, and it starts really with this candle back here, the body at least of that candle from December 16th. So that is about 3 weeks now, right there, a little over 23 days to be exact, 15 candles. And you can see that we've traded within that range. We've had a false breakout here, or one little pop above the range right there. That was January 2nd, first trading day of the year. We fell back within the range. Today it looked like a breakout, and technically it was a breakout, but not the kind of breakout I'd take if it was an individual stock, because it's not, we didn't make a solid close back above there. So all I'm saying is I'm going to watch this range, and if we fall back in the range, well, then we continue over 3 weeks now of very tight sideways trading, but relatively tight. I should use the word relatively tight. Now we look at QQQ, which is a higher beta index, and you see a lot more chop and volatility. I can't box in a 1.5% range. What I'm looking at here, you can see the size of these candles, and look at the gaps between these candles. Doesn't that look different? This little area here. Let me grab a little tool, box it in. So what stands out to me is this. That is big volatility expansion. That's in the big tech stocks, the market leaders. And back here you had extreme price compression. In fact, that takes me back to this chart, which we'll wrap up here. I posted it this morning on the site, basically comparing what we've seen recently, and we'll start from left to right here. So back in the spring, starting around early April, we had a similar period of low volatility. And what I'm looking at here, this is normal volatility. This is a market going up. You can see the candles and the size of the candles. And then when you look in here, let's zoom in real tight. Let's do that. We go in nice and tight. You see these, how small the candles and how close they are next to each other. You don't see big gaps between them. And so that is what you call a slow and steady low volatility grind higher. And what happens is nothing lasts forever. And so what happened back then is you started to see in this white area volatility expand significantly. You can just visibly see the size of the candles. You can see some gaps in between. That's usually the signs that things are starting to crack. People don't like volatility, and for whatever reason, I'm just pointing out some similarities here. So we go back here. Oh well, I'd be remiss not to point out that was followed from the high there, about a 12% correction. Same thing here. We have almost over the same time period. It was about what was it? Whatever you can visually see. It was almost identical in both scope and duration. Even the slope of the upward trend right there. Same thing. Very low volatility, small candles followed by a period of volatility expansion. That's where we're at now. I took a screenshot this morning, so we're up a little bit since then. Remember, QQ closed up today, but I also wanted to point out, which you can probably see now by this time, you probably look down below, we have high level bearish PPO crossover. What does that mean? Well, here's your zero line down here. You know, PPO, it's not bounded. It's not a bounded indicator. The RSI is a bounded indicator, meaning 100 is the top, the theoretical top, 0 is the theoretical bottom, cannot go lower than that. There's no bounds to what they are, MACD or the PPO in this case can go, but you can just look at it visually. They kind of get up to a high end or a low end during extremes, and so what you're looking at here is you had right after that volatility expansion came a bearish PPO crossover, high level, what I call high level bearish PPO crossover. You also had right before that low volatility grind, you had a little mini kind of buying climax. I won't call it a blow off top, but we'll just call it a buying climax right there. And that caused the RSI to spike for the first time in months, if not years, well above the 70 level. So you got that extreme overbought reading right there, right? But it was fleeting. And then we hit the low volatility stage. Then you hit a even more overbought and more persistently overbought. We stayed overbought conditions, marking the top right there, and then boom, the correction came. Same exact pattern back here. Brief overbought reading about 5 to 6 weeks before the correction. I don't know where that'll go. I must have made a typo there. A little pop. You can see it just about in line with that one. And then about 5 to 6 weeks later, in extreme and persistent overbought conditions right there with the volatility expansion. So look, history doesn't always repeat. This market can just, oops, looks like my PC wants to run a check. This market may just want to power on through that. So like I said, all these things are just similarities I'm pointing out. And again, until we have a sell signal, see back here, you would have had sell signals at some point, whether it was a break below that recent range. Most likely we had some 60-minute trend lines or chart patterns that broke down and then triggered a sell signal. So that's where we're at. And again, I'm painting a bearish case, things that could happen here, but again, they were still waiting. I still have some sell signals from a week or so ago, and I'm still holding tight to some index shorts. But as I said yesterday, and I maintain that, I'm not going to add until those levels break, those levels that were tested last night with the lows. And then we, so far it's basically just a successful defense of support. Nothing more, nothing less. But like I said, really seeing that price expansion or volatility expansion. That's what's concerning me right now. So we'll see how we follow through tomorrow, and then we'll go from there. If we get any type of a change, if any change in the technicals, whether it's bullish or bearish. Bullish again, what would be bullish? Taking out these divergences. Foiling these the megaphone or the megaphone broadening wedge pattern here in NQ and ES. I just paused it because I hadn't even checked ES, to be honest with you, but you can see the same thing there. I was figuring we'd probably have the same pattern. That's it. It's pretty nice looking. Boom, 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 boom. But based on it, you want to connect these reaction highs, so there really shouldn't be much upside from here. Otherwise, you're going to have a trend line that only has 1-2 points right there. Possible the whole thing could play out, but we'll see. Ideally would be to see minimal upside before we move on down. And then of course it's a pretty big pattern, so we'll have to wait to get a sell signal there. Like I said, on SPY, you can see we hit that 31.89 support last night, the futures, with a brief pop below it. But as I was talking about, you can see the 60-minute candles. That's the beauty of it. That's why I say when trading a 60-minute time frame, you want to wait for 60-minute candlestick closes for confirmation of breakdowns or break of support. And that's exactly what we had on NQ. Momentum fueled overshoot of support. You can see that 60-minute candle snapped right back up, closed above it, as did the next candle, and then boom, off to the races. So all right, let's wrap it up here, and we'll pick it up tomorrow if there's any major changes. If not, I may skip an end of day video and kind of focus on all the other things out there to watch right now, other than the equity markets. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.